Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Lindsey. Eric has done a little bit of everything when it comes to real estate. He's currently an apartment syndicator, self-storage syndicator, and mobile home park syndicator. He is also a licensed real estate agent and former owner of a janitorial service, and he wholesales mobile homes as well, a GP for a mobile home park syndication. And he, to date, has their largest purchase being over $20 million. So, Eric, welcome to the show.
Yeah, definitely glad to be here and looking forward to see if I can provide some value.
Absolutely. I want to start with really kind of your background, where you grew up and what eventually led you to real estate.
Yeah, so I'm based out of Kansas City, Missouri. I grew up in the inner city of Kansas City, Missouri. So it was a little challenging initially, but eventually caught my legs and realized that I wanted something a little bit of higher standards. And so from there, I got into carpentry. It was, I looked at the pay scales on the different opportunities that was out there between college and, grabbing a job, and it wasn't too bad. It was somewhere close to like $40 an hour for a carpenter. And so I went that path and got into the carpentry arena and started learning a lot about framing and construction, the construction process, and got super excited about that for a while. But then started hitting some really turbulent spots as far as layoffs and dealing with those unforeseen events in which I really wasn't prepared for. I didn't know that you got laid off so much in construction. But from there, I did kind of get established. I soon got what a lot of individuals would consider to be the dream job. And so it was really stable. It was great hours, great pay, $100,000 a year, great benefits. And, but I realized there eventually that, it wasn't necessarily job security that I was looking for. I was looking for financial security. And so started reading and educating, got into Bigger Pockets and consuming a lot of that content, and start looking at some different ventures, business investments, and launched into a janitorial company. We started making a little money there, but I realized that wasn't even what I was looking for, because, you have to hire, you have payroll, you have the books. And, if someone don't show up, then you have to become the janitor again. And so I made the pivot from there and went all in on real estate. Concentrated on wholesaling and started syndicating from there. And so that's kind of what led me to where I am today.
Tell me a little bit about maybe the wholesaling piece of things. Did you do traditional wholesaling as far as houses, finding kind of distressed owners, or what did that look like? And it looks like you did a ton of business in that arena. So
Yeah, so I started off in the single family world, and we got some really good traction initially. Once I started binging the Bigger Pockets podcast, I was hooked, and I was trying to figure out exactly what I wanted to do, and I nailed it down eventually on wholesaling, and I end up stumbling into a pretty good lump sum of cash off of one wholesale transaction. It was a 600 space mobile home park. I was listening to a podcast content creator. He happened to be a mobile home park owner. And what he was offering was if someone was able to bring him a deal in which he was able to close, he would pay you out a fee. I didn't really know if it was a legitimate opportunity or not. But one thing led to another. I was able to land a 600 space mobile home park. Now, granted, this was 6 years ago or something like that, where there was a lot more accessibility to the ownership. The space wasn't so consolidated as it is as of today. And so this owner of the park, he actually answered the phone, a 600 space mobile home park, and told me he wanted 25 million bucks for the mobile home park. And so long story short, I was able to put the podcaster, the mobile home park operator, and the seller together. And for about 5 hours of work, I was paid out 125 grand. So
Nice.
from there, I was kind of off to the races. I started my wholesaling company. We actually started doing some really good volume, and we were concentrating on the single family residential space. We were closing between 20 to 25 transactions yearly. So we weren't world beaters by any means,
Mhm.
but we were doing some decent volume of transactions. But as I was closing these deals, it was really good money, but I was only as good as my next deal, and I was working myself out of work continually. And so eventually I caught on, and I said, I think I need to start grabbing and capturing some of this equity in these great opportunities that I'm providing for others. And so that's kind of what led me to becoming a buy and hold investor and syndicating real estate.
Okay, fantastic. And so with the buy and hold, what was the first thing that you held on to versus wholesaling it out?
Yeah, so it was a mobile home park. My first transaction, it was a 25 space mobile home park. It was on a border of Minnesota and Iowa, and I located that by doing cold call. I mean, so that was my bread and butter in the wholesale world. So I had honed that skill, and I just transferred it into the commercial space. And so I was reaching out to mobile home park owners, and the owner of the property, it was an older lady. She had went through some pretty traumatic experiences, and I just basically called her at the right time. And really, wholesaling in a nutshell is catching people at the right time. There's a lot of people. There's a lot of people that says that there's secret sauce to it, and I get it. The more consistent you are, the more opportunities you have. But what I discovered is you just catch people at the right time, and that does come through consistency. And so the lady, she had just lost her husband. She had lost her son. And she gave me a great deal. So on this 25 space park, she sold it to me for 180 grand, and she did it on owner carry. I put 30,000 down, held it for about 13 months, bumped the rents by maybe $60 day one. And I turned around and sold it for 330. So I put about another 150 grand in my pocket on top of the 30 that I recovered.
Yeah, yeah, no, that's great. That's fantastic. And it was just it sounds like lot rent only, and you increased the lot rent to kind of brought it up towards market rent, and boom, turn around and sell it.
Yeah. Yeah, it was a great park. Really, to be honest with you, I'm kicking myself in the pants right now that I sold it, but it did serve its purpose. It was direct build, 100% direct build, 100% tenant-owned homes.
Uh-huh.
Um, and there was a park manager already on site. She didn't require much. She just wanted her driveway shoveled, or like during the snow season and things like that. So it wasn't a really expensive endeavor, and I think the expense ratio on that park was maybe somewhere around 30%.
Oh, wow. Okay. No, that's perfect. Yeah, I have a similar one where we turned it around, and I don't know if this is kind of how it was for you, but for me, it was really, kind of proof of concept. It kind of gave me that, hey, this is a viable thing. I can, buy these at one price, come in, do the renovations in some cases, and or just raise the rents, and then turn around and sell it. So that's what it kind of did for me, and kind of gave me a pathway for the next deal. So, but I do miss the cash flow from that original one. And, similar to what you said, I kind of kick myself for, selling it versus just maybe refinancing it and pulling some of the money back out. But it is what it
Yeah,
is.
it is.
Yep, exactly. So, what were some of the
Mhm.
things that maybe you learned on that first mobile home park deal that, maybe were surprises to the industry, or maybe there wasn't a surprise?
Yeah, so what was a surprise for me because I was 100% locked in on wholesaling at one point. So my knowledge base just was not where it needed to be at that level. So I learned a valuable lesson to really go all in on underwriting because had I known what I know today as far as being able to underwrite and know exactly what valuations to put on things, I would have sold that park at a much higher price. But you live and you learn, and so that's something that I store away, and I'm prepared now. And so as I move forward, it's no longer that I'm lacking the knowledge in being able to underwrite a deal and know exactly what I have and being in a hurry to transact and to sell something. I learned a lot. But as far as operational, educational things that I learned, so I learned that mobile home parks they can function really well, even in really small populated locations. So that particular location, I think the largest city closest to it, it was somewhere close to about 40,000 people. And so, my criteria at that point, I was really only looking for 100,000 plus populations, and I just didn't know how well it was going to perform. It was 100% like clockwork. If one of the properties went vacant, in which I think only one of the units went vacant at one point, I lost one house to a lady. She sold it out from under me. And that was another lesson as well. Have a really good lease to where, at least you get first right of refusal before they sell it. But yeah, so that was another lesson. She basically sold the home, and I was trying to negotiate with her, but she had ended up selling it to someone else, and they physically just came and removed the home. And there wasn't a whole lot that I could do. I didn't have much recourse because my lease just wasn't tight enough. So that was a couple of things. So being able to perform how mobile home parks still perform in really small markets, and also having a really good lease.
Yeah, for sure. And so from that initial one, what happened from there? What'd you end up buying next?
Yeah, so from there, I ended up getting into a partnership with a colleague. It was a syndication. I ventured into the syndication waters from there, and it was a 33 space mobile home park that was a little bit closer to home for me, which is Kansas City. This
Hmm.
park is just outside of Wichita, Kansas, and it had more park owned homes. Well, it actually had park owned homes. My first one didn't have any, and so that was a different experience. And then we had to deal with a legal description issue. The owner, he wanted to keep part of the land. So we had to have that redivided before we actually could purchase that. So that was a unique process, but it wasn't something that wasn't doable. It was a obstacle, and a lot of people may had went the other way on it because it did drag out. It actually took a lot longer. The transaction, in which could have been 60 to 90 days to close, it actually dragging out end up dragging out somewhere close to 6 months in order to close that deal. And so from there, I jumped into a 78 unit. I joined a mastermind of other commercial real estate investors, and we syndicated that property from there. And so that one's been it's definitely been a home run on that one.
Okay. Yeah, sounds good. Tell me maybe a little bit about that mastermind, if you don't mind. That's one of the things that I've found that's been just really good. To be able to, put your head together with other folks that are kind of trying to do the same type of thing, and a lot of them, way in a different position, right? A much further down the road, and just being able to learn from their experiences. But if you don't mind mentioning maybe what mastermind it was, and kind of what you learned from it.
Yeah, so the mastermind that I joined was the Rock Cleef Warrior Group, and he's a multifamily apartment guy, and it's just been a great experience. I would hands down do it all over again, and reason being is because of the caliber of people that you're connected to. Just as you mentioned earlier, some individuals are a little bit behind you in knowledge. Some individuals are way ahead of you in knowledge. Some people are a little bit further behind you in capital or experience, and some people have tons and tons of capital. And so just the network and the caliber of people that you're connected to is absolutely amazing. And what I like about it so much is they're locked into commercial real estate, mostly apartments for the most part.
Right.
But you have a wide array of different commercial real estate syndications and syndicators that's involved in several different niches within the commercial arena. So you've got some self-storage guys, you have some development people, you have some mobile home park RV guys, and then of course the bulk of those individuals, they're all for the most part, mostly multifamily apartments.
Okay, yeah, that's cool. And I've certainly heard of Rob and his mastermind. So cool. Good to hear that that's been something that has paid off for you. How do they meet on his? Is it all? I know he's got some in-person events, but is it over like a Zoom, or how do you guys meet up?
Yeah, so we do via Zoom.
Okay.
We also do in-person events. So there's 2 times a year that all of us, as what we consider ourselves warriors, we
Mhm.
get together, and then there's multiple boot camps that take place throughout a couple times a year. But us as individuals within the group, I mean, we're go-getters. The people within our group, there's so many of us that are strategically located all throughout the country, and we get together. So if we're doing property tours, we're trying to figure out if we have a group there. If there's some other warriors in that location, we meet up while we're there in person, go to dinner, have coffee.
Yeah.
And so we're constantly looking to network with one another and do deals with one another. It's a really robust group. I think at one point, Rod was saying that since he started that mastermind all the way up until now, there's been somewhere close to about 50,000 units that's been purchased amongst us as warriors.
Oh, wow. Yeah, that's great. Very impressive. So let me maybe go back to the mobile home park, that second one that you purchased that had a lot of the park-owned homes. What was the strategy? First, do you still have that one? And did you keep them as park-owned homes, or what was the kind of the methodology there?
Yeah, so the second one with the park owned home issue, and how I view park owned homes is an issue. And so my number one goal and our goal is to transition park owned homes into tenant owned homes so that we don't have that extra expense. Because, of course, whenever you're operating real estate and buying real estate, you want to get that expense ratio as low as humanly possible so that you could drive up the NOI. And so when you have the park owned home model, unless you're okay with that, and there's operators that are okay with that. I've heard several school of thoughts as far as the park owned home model versus the tenant owned home model. I prefer the tenant owned home model because it's a lot more passive. It's not so maintenance intensive. And then the expense ratio is so much lower when you're dealing with tenant owned homes, because when you're looking at these mobile homes that people own that lives within your park, these homes are made out of wood or they're made out of metal a lot of times. And of course, with water and just the elements, they just don't hold up very well. They are considered as personal property. And so they're huge cars that people live in. And so, it's really expensive to maintain those kind of homes. It's not like a single family home that is a lot more manageable and you don't have to put quite as much expenses into. And it's not like an apartment building that has brick or some kind of more modern material. Now, there are materials in mobile homes that mobile homes are being made of now that are similar to houses, vinyl siding, shingle roofs. All of those things are available, but a lot of the parks, when you buy these parks, they have older homes within them. So the vinyl siding and the shingle roofs, those are newer homes. So I want to say maybe 1990 or newer are those homes. And that's not always the case. When you buy a mobile home park, a lot of these mobile home parks, they're going to have some older units within them. They're going to have some 1980 units, some 1970 units. And so they're going to have different materials that they're made up of with metal roofs and such. And so I prefer to stay away from, the park owned home model. But as far as that second part, we have began to try to get away from the park owned homes and sell back the homes to the tenants. And so that's the mission as of right now. And then also to infill the vacant lots. And so that is where we are.
Okay. And with the ones that you're selling back to the tenants, are you carrying the note on them? Are you working with any of? I know there's quite a few lenders out there that will actually finance the homes to the tenants. Yeah, obviously, provided they pass certain parameters financially. What strategy are you using, Eric?
Yeah, so on the second part, I'm not necessarily into the details as far as if we're carrying the notes and things like that. I am a part owner of that park, but the third park, the 78 unit, I'm much more active on that. And so when those kind of situations comes up in our 78 unit park, we usually try to carry the note and then let them pay it back from us. And so there are quite a few different methods that operators use, just as you mentioned, with the lenders to be able to finance the homes to the individuals. But we didn't have a home that was valuable enough for us to consider going that route with the lender. So we just held the note ourselves and allowed them to place a down payment and to pay us monthly payments, and then also to keep up their monthly lot rent for basically parking the home on or within our park.
Yeah. Well, no, it's a great strategy. And yes, with a lot of the older ones, that's, what you have to do because they're not always going to be eligible for financing. But what it allows, right, with that down payment, you get some cash up front. And then, they've got some skin in the game. And then, as you mentioned with the expense ratio, right, you've got an opportunity to now all of a sudden, when something happens with that home, it's their responsibility versus the park owner. And so it keeps your expenses down. Also, what I think, I find is just that there's a pride of ownership as well, right? Now, all of a sudden, it's their home. It's not, just a rental. And there's a difference in how they treat it when that's the case. So,
Exactly. I agree with you. Definitely.
how about property management? How are you guys managing these? Well, first, let's just start with that. Maybe how are you managing them? Is it third party, or are you guys managing them yourself?
Yeah, so it's third party, and
Okay.
of course, we always manage the manager. And
Mhm.
so I think that's the best policy. Whenever you're syndicating, you have to manage the manager. That way, you can make sure that your investors' capital is going to really be taken care of and be protected, rather than just turning someone loose on the property and expecting them to do everything 100% and take care of all of the maintenance. So, so we're using third party property managers. There's one company that's a pretty good size outfit, and they go around the country, and they manage a lot of parks. And so they're doing the one that's the 33 unit. As far as the 78 unit, we inherited the manager from the owner on that one, and he's doing an excellent job. And so when he found out about us and how we came in, and things just start taking place. We upgraded the mailbox, made it look really nice. They ended up getting a new road through basically the city. Once they saw us take over and saw that we were doing things to bring the park up, they did their part and came, and since they owned the road through the park, they paved it for us. And so they went through and gave them a brand new blacktop. It looks really good. We trimmed some trees and just kind of enforced a cleanup policy. And so, but yeah, even with this new manager, or this manager that we inherited, we still manage him. And we've got a boots on the ground partner that's within 1 hour of the location there. And that's kind of how our business model works. We want to have a boots on the ground person wherever we buy real estate. We want to make sure that we've got someone within at least an hour or 2 hour drive that can get to the location to ensure that everything is good to go. And so we're trusting the managers, but we're also verifying, and we want to make sure that we can get someone there on the ground to make sure that the park and the property is being taken care of and maintained properly.
Yeah. Okay. That makes total sense. And it is good to have boots on the ground. So it sounds like on that 78 unit, you inherited the person. They're managing it. They're not per se necessarily a third party like company, but just a person that's managing it. Am I reading that right?
Yeah, so he's a person, and we created some policies and things like that, because prior to us, the owner, it was a mom and pop. He was an 81-year-old gentleman, and there was no policies, there was no structure at all.
Hmm.
And when we showed up, we had to create a solid lease. We had to give parameters for the property manager to adhere by, and so there was some things that we had to tighten up around there.
Okay. And do you know what type software you guys are using for your property management on the ones where you've got like a on-site manager, but ultimately you're tracking the rents, the late fees, all that good stuff?
Yeah, so I would need to get with the asset management team, because
Okay.
I'm not the main asset manager
Okay.
person. And that's the beauty of syndication, is you could get in various roles and play a part within a syndication in many different forms. And so on both of those deals, with my wholesaling background, I was the person that located the deal. And so
Yeah.
that was my main function in each one of those transactions within the property. And of course, I know the details of the property, but as far as assets manager, we've got an asset manager on each one of those properties, and they're the
Okay.
ones that get into the weeds on the day to day. We just received some updates.
Yeah. Makes sense. Makes sense. I was just curious more for myself as I hear what other operators are doing. So then after the 78, what is that the last one that you purchased, or do you have some others right now?
Yeah, so after the 78, we really are now focused on multifamily apartments. And so that's what I'm 100% locked in on. I want to close my first multifamily apartment deal. I haven't closed one as of yet.
Hmm.
Closed several mobile home parks, but no apartments. And so I will look at a great opportunity if a mobile home park falls on me because I do have that skill set.
Hmm.
But as of right now, I'm 100% locked in on multifamily apartments, and we're getting pretty close on a few things. We've been in best and final a few times. We had a property that was a 156 unit property that the brokers were basically giving to us, but we had to walk from it. It was just too heavy of a lift, and and a couple of the other partners, they didn't really feel as if it was the best return on our time and our investment. And so we just decided to walk from that. But 2023, it was challenging with the interest rates and then with the owners not really making the adjustments in the price to make things make sense. It was really difficult to do a transaction. As a matter of fact, I didn't close any properties within 2023, but we're making some really good progress early on within 2024.
Okay. And on the parks that you've bought, I know you mentioned that initial one was owner carry. How about some of the others? What's the debt structure been like? What have you been doing? With small bank lending. How have you been securing the financing on those?
Yeah. So the second one, it was small bank. We raised capital for that. The third one, the 78 unit, that was through a local bank that was super excited about it. We used a mortgage broker and they brought us some really great terms. We bought that property in September of 22, and that was in the height of the interest hikes that what the Fed were doing.
Hmm.
um, and the banks, they were still super excited about the asset. And reason being, we had got it at a really good price. We paid $2,250,000 for it.
Hmm.
It appraised day one at 2.8 million, and so that's before we could do anything to it. So we walked in with almost $600,000 in equity upon day one before we even implemented our business plan. And so we got some really good debt on that. And so it was a local bank.
Yeah, it's interesting how who all's open to it. And you mentioned the park owned homes on the one, and that's always from an institutional standpoint going to be a barrier if your park owned homes are too high. And so I was just curious on how that debt has worked. Maybe Eric, if you can tell us a little bit. You mentioned 2003 or 23, and some of the challenges of, finding deals that make sense, that kind of thing. But what are you seeing right now in the market? And, maybe what do you foresee over the next couple years with respect to just the market in general?
Yeah, so 23, 22, it was definitely challenging. It's something that I learned with me jumping into the syndication space in December of 21 and seeing how aggressive people were at that time. There were individuals throwing, 100 grand, 200,000, 300,000 at deals, non-refundable earnest money deposits, and paying extremely high prices for these properties. And you're seeing a lot of defaults taking place, and that's directly because people were getting way too aggressive. And so I'm actually, I count myself really fortunate to have gotten in at that point in time because I was able to see what not to do. And with that being said, I in 23, the market was, with the interest rate so high, it caused us not to be able to do deals because, we're going to be conservative. There's no way that we're going to do a bad deal just for the sake of doing a deal. And so you have to always make sure that you're a numbers driven person, not an investment driven person. There's a lot of people that get super excited about properties and how good it looks and things like that. But if the numbers are not saying that this is a sound investment, that's an investment that should not be made. And so, as far as what I see as of right now, the debt structure, it is starting to come down some, but there's still some disconnect with the sellers, and where the pricing should be. And so the prices definitely need to come down on the seller side to be able to make the numbers work and the investment work with the current debt structure that we're at. And on the horizon, I think things is probably going to just hold steady. That's my perspective. I don't necessarily think it's going to be a drastic fall because of the election. There's a lot of people that's saying once the new president gets in office that the market's just going to snap back. I don't necessarily see that. I think that things at the best, it may drop a couple of points or a couple of basis points. But as far as some kind of drastic downturn in the market going back to where it was, I think it will hold steady for a while at the bare at the most. I think it's just gonna get really steady for a while, and then where it goes from there, it's just all up in the air. No one really knows if it's gonna go back up or if it's gonna go down. I have seen some projections that it is supposed to go down, but all of that is 100% speculation because no one can predict the future.
Yeah, for sure. And I like what you said about, really analyzing the deal itself and not being in a position, for a while there, and, including some people I know, it seemed they were buying to buy, to transact. And obviously some syndicators can make, the money on the transaction of actually buying and purchasing the deal. But if it doesn't make sense in the long term, it's not going to, make sense for the investors. And that's not a long play for, a business. So it's good to hear that you are really analyzing the deal and being patient, and taking time to allow that to happen with, I think I saw the same thing in 2023 is just, it got from this super heated market to a spot where interest rates raised enough to slow this market down, right? But in that spot, it's going to take a little bit of time for the prices to come down to reality, the new reality of where they need to be. Mm-hmm. A lot of sellers are still pointing back and saying, well, we got offers at this amount, but now they no longer make sense at the higher interest rates. So there's a little bit of that time. So I tend to agree with you when it comes to, the market not drastically changing from where it currently is. I think, hopefully prices will settle down into what they, should be. And, transactions will begin to happen again at a decent clip, but not, I don't see it. I don't see the interest rates going way down, at least not in the short term. And hopefully new election, possibly new leadership, then things will, start to change in the positive, but I don't see it, just being a really big change from where it currently is. So one way or the other. Yeah.
I agree with you.
Yep. And then, so I guess maybe if you could tell us a little bit more about where people can find out more about you, kind of maybe describe your business in the future. You'd mentioned being really locked in and focused on multifamily. and kind of what you want to maybe accomplish over the next couple years.
Yeah. So if anyone wanted to reach out to me, you can go to my website. My website's name is moonlightcre.com. So that's moonlightcre.com. And as far as where I foresee myself going, I'm 100% locked in on multifamily apartments. And so I'm one of those guys. I want to be 100% laser focused instead of being spread out and not being super effective. And so I think multifamily apartments, it has a great future. I think there's going to be some great demand. And I'm also even looking into the medium size multifamily apartments as well. And so there's a lot of guys that they're syndicators and all they go after is the 70 to the 200 unit space. I want to carve out a niche in that 10 to the 70 unit space. And so I think there's a gap right there. I think there's a opportunity because when you get into that 10 to 70 unit space, there's a lot of mom and pop owners still. It's still not tapped. There's not a whole lot of the big guys wanting to come down there. And the reason being is because the management is a lot more difficult. And so you leave that 3 to 5% property management fee to go up to more 6 to 8% range, or even all the way up to the 10% range. And so because of that, you don't have economies to scale. A lot of those bigger guys, they're not wanting to come down there. And what that spells to me is opportunity. And so I'm looking at 10 to 70, but of course, I'm still looking at 70 to 200 as well. And so we're within our group, we have the means and the ability to be able to take all the above down 10 to 200 units. But yeah, I think there's going to be a sweet spot right there at that 10 to 70 unit mark.
Yeah, I think so too. And I think there's a strategy to be able to do those, right? Especially if you're focused on a smaller geographic area where you can, maybe purchase more than one in an area, or if you've got good property management that, you can negotiate across your portfolio and not just, a single deal to get those rates a little bit lower on the property management side.
Yeah, I agree with you. Well, and another thing that I see is there's a lot of guys, they've got huge portfolios of single family residential properties and they own these across the country. Or let's say they have targeted a market and they may own 30 single family residential units and they're pulling that off. So if they're able to accomplish that with individual units so spread out, if I'm buying properties 10 to 70 units in a specific market, surely I definitely can be able to pull that off with the multifamily arena.
Yeah, I think so too, because even if you, with the single family, you've got if you have 20 different houses, you've got 20 different roofs, right? If it's multifamily at all, you can have a lot more units underneath one single roof, and just so you don't have some of that. You're still going to have the, heating, AC, and all that kind of spread across. But yeah, I mean, it's definitely a way to do it. And I think you're right. There's going to be a little bit less as far as a competition in that spot. So,
Yep.
not a bad place to be. All right. And then, you mentioned syndicating, and just, before we maybe go to, I got a couple more questions for you, Eric, but before we go there, what are you seeing with your investors? Are there people still ready to, venture out and invest with, there's got to be some still willing to invest with you, but what are you seeing just in the capital markets right now with, potential investors?
Yeah, so they're still investors. So we didn't go through a situation similar to 2008, 2009, where the market just collapsed, at least within the syndication arena. And so that means individuals are still heavily capitalized. They've got cash. They're just sitting on the sidelines trying to wait for things to settle. and they're ready to jump back in. And so, what I have seen as issues here throughout the high interest rates is there's been a lot of individuals that invest passively. They've been more on the sideline when it comes to the C assets. And so a member of our team, he was raising capital down in the Houston market, and it was a C asset. It was in a C location, C/B location, and the capital raise, it became a little challenging there. And so I think it was a $4 million raise. They raised right at 3 million, pretty easily, but the last million, it was a struggle. And the biggest gripe from what my partner was telling me was that it was a C location. And so the better locations and the better markets, those B in those A markets and locations and properties, they're having less resistance when individuals are looking to invest capital. And so that's the biggest thing that I'm seeing. But there's individuals, they wanna place capital. And I still think real estate is a great place to invest capital. It still has all of the tax benefits for high income earning individuals to offset some of that capital, that active capital that they have, and to be able to utilize those real estate benefits.
Yeah, for sure. No, that's good. It's good. Good to hear your perspective on that. And then, what about? I got a couple questions, Eric, that I ask everybody, and that would be, number one, if you were to give advice to somebody who's maybe just starting out in their investment journey, what advice would that be?
Yeah, so I would say educate. And so you definitely want to take time out to educate. Don't just jump. There's a lot of guys that will tell you, take action, take action, take action. And I get the take action piece, but you want to take educated action, because when you're dealing with real estate, you're dealing with tens of thousands of dollars or hundreds of thousands of dollars or millions of dollars, and you don't really want to take a significant loss like that. And the more educated you are, the less likely you are to be impacted. Now, there's still opportunities for you to be affected or to make a bad investment, but you're just going to be a little less susceptible.
Yeah. No, I think that's good, great advice. And, kind of some of the things like that you've done with the mastermind and just being able to really ask people questions that are experienced, that are in the business, it helps out quite a bit. So I like that advice. How about any book recommendations? It doesn't necessarily have to be real estate related, but just anything that you've read recently that's been impactful.
Yeah, I've been reading recently The Startup of You by Reid Hoffman, and he's the founder of LinkedIn. I love his perspective. He is all about networking, and of course, you would you would think he would be after having a platform that he owns, LinkedIn. But yeah, he is all about building relationships and also being proactive, looking around, see where the market's heading, because there's a lot of companies that they weren't proactive, they weren't um, staying up with the times, and they ended up getting put in a bad place because they weren't keeping up with what was taking place. And so there's so many different things that's taking place around us. We've got AI on the scene, and so we need to really kind of keep our eyes open so we can stay cutting edge. I mean, the principles of investing are still the same, but there's some opportunities that's going to present themselves and are presenting themselves. And if you're not looking around for different opportunities, you could get passed by.
Yeah. I have not heard that one recommended yet, and so I've got it jotted down for myself. So I appreciate it, Eric. Well, I've
Okay, yes,
really
sir.
enjoyed our time together. Anything that I didn't cover that you want to provide or tell the audience?
Yeah, so I've got a podcast also. If you don't mind me plugging that,
No, for sure.
my podcast. Okay, perfect. My podcast is the Moonlight Real Estate Side Hustle and Syndication Show, and it's all about educating individuals about how you can operate your business on the side of your W-2 or on the side of your business. And there's so many successful people who have done that and have been able to exit their W-2. Or I'm even discovering that some people, they love their W-2 or they love their business and they have no plans on quitting it. But they're investing in real estate on the side and they're doing a great job at it. And so I just love to educate W-2 individuals and business owners about how to invest in real estate on the side of their W-2 and on the side of their business.
Yeah, that's great. No, that's a great resource, and that's kind of an aim for us as well. Here at the Wealth Flow. So cool to see that you're doing that. I know in talking with you ahead of the show, it's kind of a similar situation. We're both in W-2s and doing this, really kind of on the side in order to build wealth. So great stuff. Well, Eric, I've enjoyed our time together, and I appreciate it. You brought a ton of value to our listeners, and I think we'll call it a show. Thank you, sir.
Right, no problem. Take care, Keith.
All right.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.